We have with us from Dubai Bhavik Mehta, Deputy Head of Research and Investment Products at Century Financial. Welcome, Mr. Mehta. With the start of the new year, how do you see the future performance of US indices in 2026? Will the upward trend continue, or will the markets experience anticipated correction?
Well, to start with, we have entered 2026 with a lot of bullish and positive momentum. If you look at the overall price performance of all the US big tech names, names like Google, Nvidia, they've outperformed the markets, the broader US markets by a big margin. So overall, I would say the earnings expectations are fairly solid for the remaining for the 2026. The momentum is positive, and one of the major building factors for the equity market rally is expectations that the inflation is going to be lower this year as compared to the last year. So all in all, positive headwinds are there for the markets.
In your opinion, have the movements of the American markets are dependent on the movements of technology stocks, and what would impact the indices in the coming period?
Absolutely. So if you look at the overall the amount of weightage that the US big tech names have on the index, it's roughly around 55 to 60% of the entire US market cap. So whatever happens with the big tech names is basically going to drive the entire US equity markets action. So literally, I mean, in the financial world, we have a saying that the stock market is actually not the economy. So you can have a scenario where the labor market is down, the inflation is high, but despite the big tech AI spending, you could still see a scenario where SPX Nasdaq is taking the overall stock markets higher.
Do you agree with the optimistic tone adopted by most strategic analysts by the end of 2025?
So to be fair, what has happened is most of the analyst expectations for the positive earnings or the continuation of the equity rally are currently based on the assumption that inflation is going to cool down for the rest of 2026. But there is a big, I would say, big problem, big issue over here, because if you look at the last 2 month rally that is happening in silver, commodity, gold has been rallying since last 2 years. A lot of momentum rally has been happening in industrial metals. This is a very dangerous sign for the markets, because typically, should this commodity rally last for another 3 to 6 months, it could actually percolate down to the main PPI and the CPI, that is the inflation numbers. And with a higher inflation, even in a scenario where the labor market is soft, the US Fed hands are actually tied as to how much amount of interest rate reductions they can actually do. So I would say goods inflation going higher still remains a very big risk for the markets.
In your opinion, are we to be really conservative regarding the high valuation and the capital spending that might give fruits?
Well, so far, whatever estimates that we are getting, the kind of deals that have been happening across all these AI names, OpenAI, whether you talk about Elon Musk, X.AI, or even Nvidia, Google, and all that, the numbers look to be very much aggressive. I mean, there is a market assumption, there is an implicit assumption that it's going to go through, there is going to be no setback. In my view, the numbers are too over optimistic, too aggressive. We need to actually yet understand as to how much big monetization the AI is going to give to these big tech companies. So I would say a little bit more aggressive as far as the AI spending is concerned, the numbers are concerned.
In light of the market expectations or anticipation of the fourth quarter earnings season by mid-January, what are your expectations?
Historically, what has happened is the Q4 numbers have tend to show not major deviations from the previous Q1 to Q3 numbers. We don't expect any major deviations as such from the past numbers. What we are really looking at is the amount of forecasted spending that they're going to announce as far as this Q4 earnings are about to take place. So before the end of that is by December 2025, we were given to understand that the 2026 AI spending by all these hyperscalers would be around 600 to 700 billion dollars. We are keenly watching if there is going to be any reduction. Are they going to maintain the same base, or is it going to be more increased? so as to understand how the AI wave is going to be taken by the markets.
What are your expectations of the movement of the Feds regarding interest rate for the coming phase?
So, as I've highlighted, a lot will actually depend upon how the inflation is actually going to pan out. At this point of time, the markets are penciling something around two rate cuts by the end of this year, that is by December 2026. So, there is a pricing of nearly 50 to 65 basis points of interest rate cuts. We are given a scenario where the first Fed rate cut won't be happening before the June FOMC meeting. So again, between this period and the June, a lot is going to depend upon how inflation numbers actually come up. Should the inflation actually start to, the goods inflation actually start going higher, it's going to be a bit of a tricky situation for the Fed in, aggressively cutting the interest rates.
I would like to ask you a last question. In your opinion, do you think that the equities of AI companies will continue supporting indices, or maybe there is a shift to defense and energy sectors? Equities.
Yeah, sure. So absolutely, the US big tech spending, the US big tech stocks are going to dominate the markets. However, what we have seen over the last 1 year is a solid contribution by the US small cap and the mid cap names as well. So as you have rightly mentioned, we had companies from the energy, defense, as well as certain utility companies that are doing well because of the AI related spending. So anchor support, of course, is going to come from the US big tech. But our focus would be, apart from the big tech, our focus would also be upon the small cap names that are going to benefit from this AI wave, the US big tech spending AI wave.
Thank you very
Thank
much
you.
for being with us, sir.